Why should you know the intrinsic value of a stock? Because this value helps you understand if the stock is overvalued or undervalued. Depending on that, you'll make a decision to invest in a stock. So you see, this is quite an important factor in investment. And who else could be better to learn from on how to calculate the right intrinsic value of any stock, if not Warren Buffett, the legendary investor himself? It might take a little time and practice to fully grasp Warren Buffett's methodology for calculating intrinsic value. The concept itself is rather elusive and can be difficult to understand for those not well versed in finance. According to Buffett, intrinsic value is a way to figure out if an investment or business is worth it. Basically, it's like looking at the money you could make from that investment or business, figuring out how much money you could get from it in the future and adjusting it to account for the time and risk involved. So, intrinsic value is an estimate of the actual value of an investment or business based on the cash it can generate in the future. And in this video, we are going to provide a step-by-step guide to calculating intrinsic value. One key value that Warren Buffett favors is known as owner's earnings, which represents the cash that the owners of a company receive. Buffett defines this calculation by considering reported earnings, depreciation, depletion, amortization, and other non-cash charges, subtracting the average annual amount of capitalized expenditures required to maintain the company's competitive position and volume. So how can you do that? Owner's earnings equal the summation of operating profit and depreciation and amortization, subtracting the capital expenditure. Let's see how this calculation works in practice. For example, in 2021, Apple's operating income was $108 billion, depreciation and amortization estimated at $11 billion, and capital expenditure including payments for property, plant, and equipment acquisitions also estimated at $11 billion. So, Apple's owner's earnings were a sum of $108 billion and $11 billion, subtracting the $11 billion of capital expenditure, which is ultimately $108 billion. As you can see, the process is relatively straightforward. The only challenge lies in understanding accounting terminology and identifying the relevant values to extract. However, it's important to note that using the owner's earnings formula is only beneficial when a company consistently demonstrates earnings stability. Calculating earnings is pointless if a company's earnings fluctuate frequently. It's comparable to visiting a restaurant. You wouldn't keep returning to a place where the food quality varies. Instead, you choose a restaurant that consistently delivers, even if the quality is mediocre. Determining the growth rate of a company can be a complex task, taking into account factors such as the company's competitive advantage, the growth of owners' earnings, and other considerations that may impact company growth. To make things easier, try to find the average owner's earnings growth rate and assess whether it aligns with my perception of the company's growth. Warren Buffett also encourages us to think about holding on to a company for the next 100 years. So it's important to consider if the company's growth can be sustained over such a long period. For example, let's take the average growth rate of Apple's owner's earnings, which is 14.8%. This number is obtained by calculating the average of the owner's earnings growth rates mentioned earlier, 0.528, 0.077, minus 0.030, 0.141, and 0.026. Nevertheless, when looking at the years from 2016 to 2019, you may observe a significant increase of approximately $8 billion in owners' earnings. Additionally, after reviewing the segment earnings, you should be aware that Apple is experiencing growth in sales across its products, services, and geographical locations. Taking these factors into account, you would revise the growth rate and estimate that Apple might grow at a rate of 10% annually for the next 10 years. At this point, all we can do is make an educated guess about future growth. Now, if you recall, Warren mentioned that calculating intrinsic value involves discounting cash. But what does that actually mean? Essentially, it means assigning a value to an investment based on the amount of money it could generate in the future. This involves discounting future earnings to arrive at a meaningful present value. To calculate the result, divide the cash flow by the sum of 1 and the discount rate, raised to the power of the number of years. Explaining the intricacies of how this formula works can be tedious, so let's skip the details and dive into the calculation itself. But before that, make sure to subscribe to this channel and press the bell icon so you never miss such useful and amazing videos. The discount rate, which determines the present value of future cash flows, can be influenced by factors like inflation and interest rates. Here's a handy tip from the Warren Buffett way. Warren typically uses the 30-year Treasury bond yield rate as his discount rate because Treasury bonds offer a relatively guaranteed return on investment. Another way to think about the discount rate is that $1 today might be equivalent to $1.10 in the future, say after a year. Thus, the discount rate essentially converts the future value of $1.10 into today's present value of $1. Let's explore a general rule of thumb provided by Warren Buffett. If the discount rate is low, such as 2%, it's advisable to increase it to 4%. Conversely, if the discount rate is already high, like 10%, it's best to maintain it at that level. The rationale behind this rule is that it's unlikely for interest rates to remain low for an extended period. Now, let's delve into the formula. Essentially, what we're doing here for each year is first, apply the discount rate to the owner's earnings to determine their present value. Second, multiply this value by our predicted company growth rate for the subsequent year and discount it again to ascertain its present value. Third, sum up all the values to arrive at a final valuation. For our calculation, we assume that Apple's growth will reach 10% until year 10, after which it will stabilize and not grow further from year 11 onward. To use the formula, follow these steps. Enter the latest owner's earnings, which is roughly $107 billion. Find out the company growth rate that you believe the company will achieve over the next 10 years. Let's say it is 0.0779. Determine the possible discount rate. Let's say it's 10%. If you think the company will continue growing after 10 years but at a slower rate, include a value for the growth rate. The intrinsic value should be your market value in billions. If you want to calculate the per share amount, include the latest number of shares, which is nearly 16 billion. According to this formula, if Apple's owner's earnings can continue growing at a rate of 10% per year, and based on the latest owner's earnings of $107 billion, the company should be valued at $4,801 billion, or $4.8 trillion. And this is also known as the intrinsic value. Currently, Apple's market capitalization stands at $3 trillion. Of course, you can experiment with different numbers by adjusting the growth rate or increasing the discount rate to make the valuation more meaningful. To derive a per-share value, divide the intrinsic value by the current number of outstanding shares. In this case, it amounts to $300, which represents a 100% margin of safety compared to the current price of $180.96 at the time of writing. However, this value might seem a bit high to you, so you might consider a decreased growth rate. If we lower the growth rate to 5%, the per-share value becomes above $200, which is still quite attractive, considering the current asking price of $180.96. We believe this is the method Warren Buffett uses to calculate intrinsic value. It's important to note that this approach isn't flawless and relies on numerous assumptions. However, in our view, it does a commendable job of providing a valuation that is roughly in line with current prices, offering a certain level of reassurance. Now, it's time to put your newfound knowledge to the test. Here are a couple of questions for you. What factors do you consider when estimating the future cash flows of a company? How does Warren Buffett's approach to intrinsic value differ from other valuation methods? We'd love to hear your thoughts and engage in a discussion in the comments below. If you found this video helpful, don't forget to hit the like button and subscribe to our channel for more insightful content on investing and finance.